Good morning, everyone. Welcome to this update for global stocks and commodities for the 23rd of September. It was a very good week last week, particularly in the US, where we saw the Dow Jones actually join all the other indices in setting new all-time highs. And it would appear now that fears about what the trade tariffs might do seem to be fading into the background, as was probably always going to happen, as I've been saying. So in this update, to me, the market message couldn't be any clearer than what it is at the moment, particularly in the US. And so all the lights, I beg your pardon, all the lights are green there. And Australia, though, the outlook is rather mixed. Certainly economically, the outlook is, I think, a little bit concerning with the housing market definitely coming off the boil. If commodity prices do remain subdued or get even more subdued because of events in China, then it's going to impact the Australian economy quite dramatically. And there are signs that the Australian consumer is pulling back. And you've only really got to look at the share prices of a lot of our consumer discretionary stocks to see that. So the outlook here is pretty mixed. We've had some high flyers that have been fantastic, but the valuations of some of those stocks are extremely stretched. You know, we're talking about PE ratios of 50 to 100 and even above. So I think it's fairly hard going in Australia at the moment. You've got to be careful. Yes, there are opportunities, and I've been highlighting some of those opportunities certainly in Portfolio Analyst and in my other subscription services. But it's getting harder and harder because a lot of the really good growth stocks have risen so much that there is risk around them now. We'll just look at the general stock and commodity updates as usual, of course. And in Portfolio Analyst last week, I introduced a couple of really outstanding local small caps that are also excellent value. So that's exactly what I'm talking about. Stocks that are cheap, that are on PEs of around 10, have high growth rates and an enormous upside potential on a global scale. So I'm very excited about those two in particular from last week, but there's been quite a few others along the way. I'll be continuing the series on the best performing US industry groups and identifying opportunities there, and there's certainly plenty of material to go on. And I just want to make mention to a couple of changes we're making to the trial on Portfolio Analyst. So just quickly, for those that perhaps new to this video, we've been providing a free trial for Portfolio Analyst all year, and a lot of people have taken advantage of that. Our intention was to provide, and I should add too that not only have a lot of people taken advantage of it, but the retention rate of people that go on and become members is also extremely high. So I'm very pleased about that. So obviously we're hitting the mark in terms of what people are looking for. Now, our intention was to provide a chance for people to see if the service was right for them. That was it, purely and simply. But we did get some feedback that some people didn't see why they should have to provide their payment details when it was a free trial. And secondly, because of the platform that we were using, there was only a PayPal option. So we've made two changes because we want to give as many people as possible the opportunity to take the free trial. If you don't want to join the membership after that, then that's absolutely fine. But we want to make sure that there are as few barriers to people trialing this as possible. So the two changes we've made is we're now providing a credit card option as well as PayPal details. So that means that you don't need a PayPal account. So for anyone out there that's been a barrier for them, then we've now removed that. The second change we've made is that it's now a $1 trial instead of a free trial. Now, why have we done that? Well, look, I just want to be upfront, and I've had this conversation with a few people. we just want to be upfront that this is a business exercise for us. Sure, we want to give you the opportunity to decide for yourself with first-hand experience if it's right for you. But it is a business exercise for us. We're hoping that lots of people will join. But let me stress a couple of things. If you take this trial for $1, you're going to get access to everything that we've got there, all of the archives, all the previous recommendations, an incredible amount of education and learning for 2 weeks. There's a searchable database. You can look at every analysis that has been done over the more than 12 months now. So the bigger we can make the membership, the better it is for everybody. I'm making a lot of well-researched and frankly highly successful recommendations, but members are also raising questions about some very exciting stocks that I was completely unaware of previously. So as the membership grows, there are more eyeballs on the market, and that just benefits everyone. So I really see this as a win-win outcome all round. Many of the most successful local high flyers, and anyone that follows the market in Australia would know which stocks they are. So many of those that have risen hundreds and hundreds of percent have been recommended. They've been highlighted, well back in 2017. So I'm not just jumping on the bandwagon recently once these stocks have hit the media. These have been recommended quite some time ago, and they've been recommended repeatedly, some of them 7 or 8 times over the last 12 months. So the trial is now for $1. There is no obligation after it. You can just, withdraw from the potential membership, and I think at the very least you would have had some terrific education about how I go about analysing stocks and particularly analysing the market. So I hope that those changes will make Portfolio Analyst even more appealing than it has been. So moving on, American stocks. The S&P went up 34 points for the week. All indices were higher, but the Dow was the big winner. And that has a real psychological impact on the market because whilst, in my opinion, the Dow Jones index is a bit of a nothing sort of index, the fact is that a lot of people do follow it, and it just has a psychological impact on the market. And when the Dow breaks out, it is going to tend to draw in a lot of people that have been sitting on the sidelines. So I think it can only be a good thing for the bulk of the market. The breadth is still strong. Small cap valuations are still absolutely fine. On average, they're growing their earnings by around 20%. Stocks in the Russell 2000. And yet the average PE ratio is still only around the 16 mark. So breadth is great. Valuation's not an issue. Trade tariffs outcomes are now not as bad as what was expected. Instead of some of the 25%, so I think most of it is now at 10%. So the market has sort of got over its fears about that. Earnings growth was terrific, and the forward guidance was also excellent in the US, and valuations are absolutely fine as a consequence. So those factors of earnings growth and valuations and the incredibly low jobless rate and all those things are all starting to exert themselves now that people are less worried about tariff outcomes. The US dollar was down again, not a lot, but it was down again, and that's really a consequence of the trade fears easing. So let's jump in and take a look at some of the American indices. So here's the Dow Jones. So you can see it was the last of the 4 major indices to break out, and it's now set a new highs above where it was in the end of January. So symbolic only in my view, but it's a symbolism that does impact the market, that's for sure. This is the S&P. So we broke out in the S&P in August. We came back, retested the breakout, and now we've advanced again. This is perfect textbook market action. Breakout, retest, and then move away quite sharply without any delay. So very positive on the S&P. If we look at the Russell, if we look at the Nasdaq, you can see this is the January highs. So we went to new highs in March, and then have just continued to blast on from there above 7,500 points. And finally, the Russell. So there's the January high, there's the March high. So it was not doing quite as well as the Nasdaq, but then since then it's really burst away and just continues to set higher highs and higher lows. So very impressive in all the US indices now. This is the US dollar. So it eased a bit with the trade fears. And if we go to, while I'm here, let's go to the Australian dollar. So the Australian dollar really just bouncing back from those highs seen in the US dollar. But you can see clearly the trend is still down, and there's every reason to suspect that the trend will remain to the downside. It'll bounce around with perceptions about trade, but clearly at the moment the direction is still to the downside. So let me just check in on the ASX 200 while I'm here. So you can see we had a bit of a rise last week. I think it was up around 30 points, but I don't place much stock in the ASX 200. I think again it's a reasonably meaningless index, and because it just represents the top 10 or 15 stocks, so it doesn't really tell us very much about the market in general. Most people who are interested in what the ASX 200 are doing are passive investors. They're not active investors, and I would assume that that this particular forum is very much about active investors. Okay, so just recapping on Australia, the Aussie dollar up to 72.9, and our index was up by 30. Now these were the two comments that I made last week that are still valid, and I couldn't think of anything more appropriate to write, and that is that we have this very tricky balance between momentum, the momentum stocks that have gone up hundreds of percent but are now at an excessive valuation that would appear to be unsustainable. So that's always difficult, because we've got stocks that are going up and continuing to go up, but at some point that's going to run out of gas, and the prices are going to fall probably quite sharply. And we've also seen some big moves in some new technology concept type stocks, and they're some of the ones that are being highlighted in Portfolio Analyst. So some very exciting opportunities there. Some of them aren't profitable yet, and therefore we can't really get a gauge on valuation, but some of them are profitable and they're cheap. Relative to their growth rate, they're exceptionally cheap. So I'm very excited about some of those opportunities in Australia. Precious metals, gold was up by $5 to 1,200, but look, it's just following currency. And the precious metal stocks, there was some useful follow through on the global majors. So if you look at GDX, and we'll look at that in a minute, there was some useful follow through. But to my mind, if you want the best performing gold stock on the planet, it's Northern Star, and they hit the global stage in the last week with their purchase of a very world-class mine in Alaska. Now, this isn't a forum where I make recommendations, and this isn't a recommendation for NST, but I've mentioned it from time to time. I've followed it very, very closely since late 2010. It's been throughout my recommendation services, all throughout the last 7 years. And I started first following the stock when it was 10 cents. It's now $9 or nearly $9. And I've said repeatedly it's the best gold stock on the planet in my view, not just because the price has gone up, but because of the financial fundamentals. And if you wanted to make money out of precious metal stocks, I don't think you need to go too much further than Northern Star. But again, that's a long-term trend comment. That is not a recommendation that now is necessarily a good time to be buying it. But certainly it's been a tremendous performer. So let's just look quickly at precious metals. So a little bit of an up week. This is a weekly chart on gold. A little bit of an uptick. Did get to $1,212, but gave it back at the end of the week, and so only advanced by a small amount. So still looking fairly weak and shaky on the gold price. If we look at GDX, again a little bit of we steadied last week and a little bit of an upward tick, but when you compare that price action to the price action on Northern Star, and let's put that on a weekly basis so that we're looking at the same thing, I think you can see that there's just absolutely no comparison whatsoever. So that's my view of the gold market. Other commodities, copper was up sharply to $2.82. And once again, the fearmongers who thought that the trade wars would lead to a significant reduction in global growth, and therefore the futures market really belted the commodity prices. Those fearmongers have been proven wrong yet again. The impact from trade wars is probably going to be minimal, and in the US, if anything at all. I was reading an analysis this morning that basically presented the fact that any impact from tariffs are probably only at worst offsetting the benefit of the tax cuts in America. So all that fear and concern was for no particular reason. Crude oil also jumped up to 70.78, and US production is absolutely booming. And there are some Australian small caps that are basically active in the oil and gas space in America and providing some really interesting, powerful trends. Now, just to underline how the US production is booming, over the last 10 years, the time that it's taken to drill a well in the US has fallen by around 90%. So they're doing it nearly 10 times quicker, and production is nearly 10 times higher. So it's pretty easy to see why things are booming there in the States. There's the spot copper chart. You can see right over on the right-hand side there the move up during the week, and similarly we've moved up in crude oil as well. So just to wrap it up, overwhelmingly, and this theme is really underpins everything that I've been saying for more than a decade. You want to watch the market, not the headlines. Trade what you see, and not what you think. All those sorts of themes. The US indices are short-term overbought, but I believe any pullbacks should be quite mild and have been quite mild. We haven't had a decent pullback now since the pullback at the end of January, which of course was just from a stupidly overbought position anyway. I mean, that was always going to happen. So I think as long as we keep moving forward, 2 steps forward, 1 step back, we avoid the excesses that we had in January, then I think we're going to see a pretty good end to the year. Now, Portfolio Analyst this week, I'm going to be reviewing some of the local high flyers, both from a valuation perspective and also just from a chart trading perspective as well. What are the tactics that you should be applying to these sort of stocks? And I'll also be continuing the series on the best US industry groups as well. There's my contact details for anyone that has not been a member of any of my services, and I'll be back with you next week. Cheers.